So next up, we're going to be talking about taxes. So one common question that retirees have is, how are my retirement benefits going to get taxed? What taxes do I pay on my retirement savings? How does it all work? So this video, we're just going to break down the different tax situations that you're going to find yourself in and how they all work, so you can be better prepared going into them. Later in this video, I'm actually going to show you guys something that I like to call the teacher's retirement tax trap. Now, this tax trap applies to all state employees, not just teachers. We'll be debunking the myth that in retirement, I'm going to be making less money, therefore my taxes are going to be less. So let's bring up the whiteboard here. So when it comes to taxes in retirement, for the most part, they work just like they currently do. You work, you get a paycheck, you pay the federal taxes. So most of your income is going to be paying taxes in that manner. Remember that your pension is fully taxable, Social Security is taxable, money in your Plan 3 retirement account is all taxable, the DCP is taxable, your 403B is taxable. So you're going to do taxes on all that money as well. The taxes work a little bit different in those accounts. So let's just kind of quickly go through them. So there's basically 4 different ways taxes work. So the first one is what we call ordinary income taxes. So ordinary income taxes are what you guys are currently paying. So this is when you look at the tax schedule, the tax brackets, those brackets apply to ordinary income only. So what is ordinary income? It's money from W-2 wages, right? So your salary you get from your employer falls into this bucket. Most self-employment, so you get a 1099, also falls into here. If you have rental income, as well as any interest you get from CDs or your bank account, and then the dividends that get generated from any kind of stock portfolio that you have. Those all fall under ordinary income tax rates. Now, pension, Social Security also fall in this bucket here. So now the second bucket is the tax-deferred bucket. Right? So tax-deferred are your pre-tax accounts. It's money that you put aside, got a tax deduction while you're working, but you did not pay tax on this money yet. So again, this is Plan 3, the DCP, or 457 as some people call them. They're the same thing. Your 403B, and then any money in an IRA. Those are pre-tax accounts. So this money hasn't been taxed yet. So at some point, you're going to want to take money out of this. What happens is they no longer become tax deferred. You instead, they're going to move over into this bucket to the left here. They're going to pay ordinary income taxes on it. So it looks like a paycheck to the government when you take a distribution from these accounts. So if I take out $10,000 from one of those accounts to the IRS, it looks like I just made a $10,000 paycheck. So I'll be taxed as such. So it gets added to your total income. If you take out too much, you may change tax brackets and therefore have to pay more taxes on that money. So it's just one more thing to kind of keep in mind before you start taking retirement distributions. Now, the IRS has been patient with you, letting you take a tax deduction and deferring paying your taxes to a later date, but they're only so patient. So under current law, at age 72, they're going to force you to take this money out. Whether you want it or not, you're going to be forced to take the money off your payers' accounts and pay your taxes on it. And this is what they call a required minimum distribution. Abbreviated, it's RMD. So at age 72, this is when you're going to be mandated to take this money out. Now, if you forget to take money out of your account, they hit you with a 50% penalty. That's right. It's one of the worst tax penalties that we have. So it's not something you want to forget about. Now, the next category is capital gains. So capital gains tax rates only apply to certain investments, and you have to have held them for at least 1 full year. So if you have an investment such as a stock and you sell it within that first year, you don't get the capital gains rate. You instead get the ordinary tax rates, so which are much higher in most cases. So the capital gains hold at least for 1 year. The tax brackets are going to go between 0 to 20%. Right? So what falls in here is money held outside of a retirement account. So if you just go and push bought a stock or something through like an online platform, it's not an IRA or Roth or anything like that. Those are what they call non-qualified accounts or brokerage accounts, and you'd fall into this category here. And so any kind of stock, bond, ETF, Cryptocurrencies also fall into here, as well as any kind of investment property. So if you have a rental and you decide to sell it later on, the gains you got in those accounts, right? The purchase price plus the price you sell it for, the amount you actually earned on it is going to be taxed at capital gains tax rates. Now, the fourth and final tax bucket is going to be the tax-free area. So now, what is the tax-free asset? The most common ones are anything with the word Roth in it, right? So this could be Roth IRA or Roth 403b. Money that gets put into Roth accounts, you pay the taxes up front. So before you made the contribution, you pay taxes at the ordinary rates. And now the benefit of that was you paid them up front, and now any money in that account grows tax-free and can be pulled tax-free. So the benefits of having money in this account is you have full flexibility of when to take it out, and it won't affect your ordinary income tax rates. So if I took money off of my Roth account, I took $10,000 out, it does not get added to my income. And this is good because not only does it not increase my income, but certain things like Social Security and Medicare, they look at your income to determine how much of it's going to be taxable. So this is a way for me to take a potentially large sum out of a tax-free account, does not throw up my income, will not increase my Medicare premiums or increase the taxes on my Social Security. So having money tax-free is a good thing to have. Once you're retired and have access to your accounts, you have something available called the Roth conversion. Now, this is only available as long as the tax code allows it, but essentially you can take money from the tax-deferred account and move it into the tax-free bucket. Now, when you do this, it's still a taxable event. So whatever you move over still has to trickle through the ordinary tax bracket first. Once you pay the taxes on it, you can track it down to the Roth IRA account. Then it can continue to be invested and growing tax-free for you. This is what they call a Roth conversion. Now, let's flip over to show you guys why the myth of when I retire, I'm going to be making less money, therefore I'll be paying less taxes, does not hold true for most state employees. Now, it all comes down to your pension plan. So we look at most Americans first, right? So most Americans, they work. Let's say they're making $100,000 somewhere. They go to retire at 65. They have Social Security, and that's it. All the rest of their income has to be made up from their 401k or their Roth accounts, stocks, any other money they've saved. So they have a big gap to make up. So when you read a lot of these articles that say you need to have X amount saved for retirement, this is what they're talking about. This applies to about 90% of the population. But as I said earlier, you guys have a special situation, special benefits that make your retirement really great as long as you utilize them properly. And this is why it's important to talk to a specialist when you're doing your retirement planning, because they'll know all the ins and outs of your benefits so you don't get the wrong advice. I can't tell you how many people have come to me over the years that said, my advisor told me this, and they didn't even look at their pension at all. They didn't do any kind of calculations, none of it. So they were telling them wrong advice and kind of scaring the client, telling them that they needed to save $30,000 to $40,000 more per year to even have a chance of retirement. But in reality, they could put away $0 and still make more money in retirement than they currently are. It's important to understand your benefits. So now let's look at what this looks like for a state employee. So same thing here. Let's say this person is single, making $100,000, and they want to retire at 65. So you also get Social Security here in Washington State. You guys paid into it, but you guys also have your pension, right? So the pension is going to take up a big chunk of this. Now, how much this is kind of varies on which plan you're on, right? Plan 2 or plan 1, as well as your salary that you made while working and how many years you put in. So those are the factors that determine it. So let's say this person retired 65, was able to get $2,000 a month or $24,000 per year from their Social Security benefit. Let's say they put in 34 years into their Plan 3 account. They're single, so they just take the max pension option. They're going to get $34,000 per year from their pension. So if you add those numbers up, it's $58,000. Right? So $58,000 is the baseline income for someone in retirement. So this money is guaranteed. She's never going to go less than this. Plus they have cost of living adjustments on it. So that sounds great, and it is. It's good to have guaranteed income, but from a tax standpoint, you can never go less than that. So if the tax bracket cuts off at 40,000 and you're up at 58, you're always going to be in that upper bracket. You can't do anything to adjust your income to drop tax brackets anymore. Okay, so under the current tax law, $100,000 is in the 24% tax bracket. But remember that we have a marginal tax system here, so they go in bumps, right? So if we look at the current code, about from 40,000 to about 89,000 is a 22% bracket for someone that's single. Any income between 89 and 100 would be taxed at 24%. In this case, if they're at $58,000, they're right smack dab in the middle of that 22% bracket. They're still going to be paying 22% taxes on that money, above the 40,000 threshold. Now, why is this important? Because if you have any other money, right? So if this is Plan 3, they have savings, right? In the TERS 3 defined contribution plan. Some people call it 401k. We just call it the bucket. So you're going to have some money over here. They're going to want to take some of that money, likely, to help make up that gap or that difference. Somebody's going to get transferred over here. They're going to have to pay whatever tax bracket you guys are in. So the 22% bracket, every single dollar gets pulled out of their retirement account gets taxed 22%. And again, if you pull out too much, you're going to bump brackets on that. So this person, they're going from a 24% tax bracket to 22. It's a very minor decrease. And honestly, once they start taking money off of this retirement account, they're going to be much closer to what they were at before. And of course, taxes change. If the tax bracket goes down or the rates increase, more than likely they're not going to see any kind of shift in income. Now let's shift gears a bit. Look at a couple in this scenario. So if we have a couple, let's say both of them work for the state. So maybe they're both teachers. So they're both going to have pensions coming in. So in this case, you're going to have 2 Social Security checks. And you're going to have 2 pensions, right? So you're going to have that total all of that up. So if this couple was making closer to, say, $200,000, under the current tax code, they're going to be in the 24% tax bracket. Now, let's say one of them was on Plan 2 and they worked, 35 years. They get 70% of their income. So let's say one person here had $70,000 of income coming in for their pension. The other person was Plan 3, maybe worked a little bit less. Let's just say they had $30,000. So that's $100,000 alone just from the pensions. Add Social Security to that. Let's say they were smart, lived off some savings and wanted to delay Social Security to a higher age, and they got their max benefit. One person pulled in $2,500 per month or $30,000 per year. One person pulled in, say, $30,000 per year. And let's say the other one was also at $30,000. So now their guaranteed income is at $160,000. So this puts them in the 22% tax bracket. The bracket shifts under the current tax code at $70,000. So if they take more than $18,000 out any particular year from their investments, they're back into the 20% bracket. So the myth of, hey, when I retire and making less, therefore my taxes are going to be way lower, is not true. Will they go down? Yeah, maybe, but very slight. In some cases, not at all. And in some rare cases, you'll be in a higher tax bracket. So this is an important concept that you guys are going to want to understand when planning for your retirement. So when you're doing your retirement contributions, it's important to look at the future and see what taxes are going to potentially look at forming when everything is turned on. When I have my Social Security coming in and my pension turned in, what tax rate am I going to be at? Because remember, the pre-tax accounts typically don't work out well, because while you got a tax deduction while you're working, you only got a deduction of the contribution amount. The money grows over time and is usually a lot larger than what you initially put into it, taxing the entire amount. The Roth is the government's way of giving you the chance to pay them now and for you to go tax free. So if taxes go up in the future, you come out ahead in the Roth. If taxes stay the same, you break even. The only time the Roth doesn't work out is if taxes go down, and even then it still can make sense in some cases. So for example, if you have $100,000 in one of your pre-tax accounts, and you're in the 30% tax bracket, that's going to cost you $30,000 in taxes. That's what you owe the government still. But if we're in a tax-deferred account, and this continues to grow over time, and let's say it gets to $1 million, we still haven't paid any taxes on this money yet, but let's say that our taxes did go down. Let's say something happened and taxes in the future were at 10%, so a lot lower. Now you're going to owe 10% of $1,000,000, which is $100,000. So your total tax bracket in that case is $100,000 rather than $30,000 if you were to contribute into the Roth in that scenario. So you pay $70,000 more in taxes. Now the chances of going from 30 to 10 is highly unlikely for the reasons I just showed you earlier, because you have those pension plans. So you're probably going to pay more in taxes when using the tax-deferred strategy. Now, this is not tax advice. This is totally hypothetical. Your situation is unique to yourself, but this is something that I want to bring up for you guys to talk to with your advisors or your CPAs to make sure you're putting the best plan possible together for yourself. Now, if you need some help in this area, the link to get on our calendar is right below this video. Your specialist is working with state employees, solve some of these complex problems, and utilize their great retirement benefits. If you'd like to book a call, the link is down below, and I hope to speak with you soon.